Hello, everyone. Welcome to this week's lecture videos. This week, our topic is liability and liquidity management, and we are covering chapter 15 this week. And as usual, we have few learning objectives. And in this video, I will be mostly talk about the role of liquid assets in the management of liquidity risk and the reasons for holding liquid assets by the financial institutions. And this is the overall outline of this week's presentation, which will be divided into several videos. First of all, you probably can recall in the last chapter, we discussed that depository institutions and life insurance companies are especially exposed to liquidity risk. The essential feature of this risk is that financial institutions are relatively illiquid in the face of sudden withdrawal of liability claims. The classic case of liquidity risk is a bank run where depositors demand cash as they withdraw their claims from a bank, and the bank is unable to meet these demands because of the relatively illiquid nature of its assets. For example, it could have a large portfolio of non-marketable commercial business loans. To reduce the risk of a liquidity crisis, depository institutions can insulate their balance sheets from liquidity risk by efficiently managing their liquid assets positions or managing the liability structure of their portfolios. Most depository institutions managers incorporate both asset management and liability management as part of overall liquidity management strategy. In reality, a depository institution manager can optimize both its liquid assets portfolio and the structure of its liability to insulate against liquidity risk. In this chapter, we will discuss the various liquid assets and liabilities a depository institutions might use to manage liquidity risk and the risk-return trade-off associated with various liability and liquidity strategies employed. Now, sources of liquidity. Management of liquidity risk requires an understanding of all sources of liquidity available to a financial institutions. You probably again can recall that these were discussed in chapter 24. And in summary, these can be mentioned as asset liquidity or purchase liquidity. Asset liquidity includes money market instruments such as treasury notes, treasury bonds, and short-term obligations such as certificates of deposits and bank accepted bills. These are liquid in the sense that they can be traded readily with minimal loss of value. Generally, assets are considered highly liquid if they are high credit quality and either of short maturity or very marketable with little chance of loss of value. However, such assets usually offer depository institutions a low return. Hence, the stock of liquid asset held in a depository institution's balance sheet will depend on depository institutions' willingness to trade off liquidity and returns and the depository institution's use of purchase liquidity. Okay, so these decisions by and large depend on the size of depository institutions, its reputation in the market, and related lender confidence in the depository institutions. Okay, just to remind you, as we discussed last week, that asset liquidity is a holding of liquid assets such as cash and short-term securities, which either will mature and be paid when liquidity is needed, or are readily sellable without material losses. Purchase liquidity, on the other hand, is a depository institution's reliance on access to money market to borrow on so-called purchase funds to deal with cash shortfalls. In addition to the traditional sources of liquidity, as we discussed, financial institutions securitize standard loans, particularly housing loans, or they enter into loan sale agreements. The use of repurchase agreements is another way financial institutions manage their liquidity. Finally, financial institutions can use the capital markets to raise funds via subordinated notes, preference shares, and even ordinary capital to finance its liquidity needs. Although this is a longer term process and unlikely to be useful when there is liquidity strain. Further, raising capital in such circumstances may send a clear distress signal to the market. Next is liquid asset management. A liquid asset can be turned into cash quickly at low transaction cost with little or no loss in principal value. We discussed about liquidity index in the last chapter, if you can remember. Specifically, a liquid asset is traded in a deep market where even large transactions in that assets do not move the market price or move it very little. Good examples of liquid assets are newly issued treasury notes and treasury bonds. The ultimate liquid asset is, of course, cash. While it is obvious that a financial institution's liquidity risk can be reduced by holding large amount of assets such as cash, treasury notes, and treasury bonds, financial institutions usually face a return or interest earnings penalty from doing so. Because of their high liquidity and low default risks, such assets often bear low returns, reflecting their essentially risk-free nature. By contrast, more illiquid assets such as bank loans to commercial borrowers often have to promise additional returns or risk premium to compensate depository institutions for the relative lack of marketability and greater default risk of the instrument. Holding a relatively small amount of liquid assets exposes a depository institutions to enhance illiquidity and withdrawal risk problems. Excessive illiquidity can result in financial institutions' inability to meet required payments on liability claims, and at the extreme can result in insolvency. It can lead to contagious effect that negatively impact other financial institutions. We discussed this contagious effect in the last chapter. Consequently, regulators tend to impose minimum liquid asset requirement. Okay, so regulators impose liquidity requirement to limit the risk of a run on a bank. Apart from this one, regulators also impose liquidity requirements to influence monetary policy and taxation implications. So regulators set minimum liquid asset requirement, the two reasons that I just mentioned in the previous slide, that are to meet expected and unexpected liability withdrawals. These are undertaken for the purpose of both monetary policy and taxation implications that results from holding reserve requirement. Okay, so first of all, the monetary policy implementation. Many countries set minimum liquid asset reserve requirements with the objective of strengthening monetary policy, especially setting a minimum ratio of liquid reserve assets to deposits or some other base limits the ability of financial institutions to expand their lending and enhances the central bank's ability to control the money supply. A decrease in reserve requirements ratio means that depository institutions hold fewer reserves against their transaction accounts. Consequently, depository institutions are able to lend out a greater percentage of their deposits, increasing credit available to the economy. Therefore, a decrease in the reserve requirement results in a multiplier effect on the supply of depository institution deposits and a resultant expansion of the money supply. Conversely, an increase in the reserve requirement ratio means that depository institutions must hold more reserves against the transaction accounts on their balance sheets. Consequently, they are only able to lend out a smaller percentage of their deposits than before, thus decreasing credit availability and lending, and eventually leading to a multiple contraction in deposits and a decrease in the money supply in the economy. And regulators also impose liquidity requirements for taxation reasons. So in this case, depository institutions holding of assets in the form of liquidity reserves forces depository institutions to invest in government financial claims rather than private sector financial claims. That is, minimum liquid asset reserve requirements are an indirect way in which governments can raise additional taxes from depository institutions. While these reserves are not official government taxes, having depository institutions hold cash in the vault or reserves at the central bank requires depository institutions to transfer a resource from the banks to the central bank. In fact, the profitability of many central banks is contingent on the size of this reserve requirement tax they can levy on banks under their jurisdictions. The tax or cost effect of low or no interest reserve requirements is increased if inflation erodes the purchasing power or value of those balances. This is the end of this video. In the next video, I will be talking about the composition of the liquid asset portfolios. Thank you very much.